Gotta love it when that dividend payment hits your account.
Oh, yeah. Especially these days.
Yeah.
Who couldn't use a little extra cash flow, right?
Exactly. And that's what has us, well, diving into these ultra-high yield REITs like WP Carey and EPR Properties.
Yeah, but here's the thing about those tempting payouts.
They can be a little too good to be true sometimes.
It's like that old saying, if it seems too good to be true.
It probably is.
Right. It's a balancing act, risk versus reward. Got to be careful.
For sure. So before we get into the weeds on these specific companies, let's make sure everyone's on the same page about REITs in general. What are we even talking about here?
Basically, REITs are companies that own and often operate income-producing real estate.
Okay, so like shopping malls, office buildings, apartments, that kind of thing.
Exactly. And the thing is, they have to distribute a big chunk of their profits to shareholders as dividends. That's kind of their thing.
Ah, so that explains the dividend love. But let's rewind a bit, back to the pandemic. That was a wild time for everyone, but especially for REITs, right?
Oh, absolutely. Talk about a shakeup. Imagine owning a REIT that specializes in, say, shopping malls, when suddenly everyone's stuck at home buying everything online.
Or office buildings when everyone's working remotely.
Exactly. Tough times.
Tough times indeed. Okay, so let's dive into the specifics, starting with WP Carey, ticker symbol WPC. This REIT had like a stellar track record, right?
They did. We're talking 25 years of consecutive dividend increases.
Yeah.
They were a dividend aristocrat. Until
the pandemic came along and messed everything up.
Yeah, office spaces really took a hit, and WPC had a lot of their portfolio tied up in those. Occupancy rates plummeted. Companies were embracing remote work left and right. Suddenly, that nice, reliable income stream from those office leases wasn't so reliable anymore.
Yikes. So what did they do?
Well, they made a big decision, a tough one. They decided to just completely exit the office market.
Wow. Just like that.
Well, not exactly overnight, but you get the idea. Bold move, and it came with a cost.
Let me guess. They cut their dividend.
Yep. First one ever for them. Broke that impressive streak.
I bet their investors were not happy.
You could see that again.
But at least they still had a decent yield, right?
That's the thing. Even after the cut, it's still sitting at around 6%. Not too shabby. And the really interesting part is what they did next. Instead of clinging to a struggling sector, they took that money from selling their office assets and got strategic.
Strategic how?
They put it into industrial real estate.
Ah, so like warehouses, logistics centers, that kind of thing. The backbone of all that online shopping everyone's doing these days.
Precisely. They saw the way the wind was blowing. Everyone wants their stuff delivered yesterday, and that takes a lot of warehouse space.
Smart. So they were basically doubling down on the whole e-commerce boom.
In a way, yeah. But selling off those office assets wasn't just about jumping on a hot trend. It was also about strengthening their overall financial picture.
Okay, so explain that one. How does selling things off make a company's finances stronger?
Think of it like this. Imagine you have some credit card debt.
Who doesn't?
Right. You could keep making those minimum payments, or you could use a chunk of money to pay down a big part of it, which is better for your finances.
Paying it down, obviously. Lower payments, less stress.
Exactly. And that's kind of what WP Carey did. They used some of that cash from selling those office buildings to reduce their debt.
So it's like they were streamlining their portfolio and shoring up their finances at the same time, like a two-for-one deal.
Exactly. Smart move, right?
Definitely. So what happened to their dividend after that cut? Did they ever manage to recover?
They did. In fact, they've already started increasing it again.
Wow, that's impressive. So they're back on track, dividend-wise. What's their strategy going forward?
Well, they're tying their dividend growth to their adjusted funds from operations, or AFFO.
Hold on. Jargon alert. What's AFF?
Oh, right. Sorry. It's basically a REIT's version of cash flow. It's a measure of how much cash they generate from their operations.
Got it. So tying dividend growth to AFO basically means?
It means they're committed to a sustainable approach, which is always a good thing. They're saying, look, we're only going to increase the dividend if we have the cash flow to support it.
Which makes sense. Nobody wants to see those dividends disappear if things get tough again. Speaking of tough, let's move on to our second ultra-high-yield REIT, EPR Properties. Ticker symbol EPR, for those playing along at home. Now, these guys are a little different from WP Carey. They focus on what they call experiential real estate. What does that even mean?
So think about places people go for fun, for shared experiences.
Like amusement parks.
Yes.
Movie theaters.
You got it.
Concerts, maybe.
Sporting events.
All of that. EPR's whole thing is investing in properties that bring people together. It's the stuff we missed so much during the pandemic.
Oh, man, yeah, those were dark times. Remember when everything just shut down and suddenly the idea of going to a crowded movie theater seemed terrifying?
Yeah, everyone was just huddled up at home, baking bread and doing Zoom calls. Not exactly a recipe for success when your tenants rely on people actually showing up. So basically, EPR was in a really tough spot. Did they just, cross their fingers and hope for the best?
Hope doesn't pay the bills, right? Had to pivot. Yeah. Just like we talked about with WP Carey shifting away from offices, EPR realized they needed to diversify their portfolio too, get away from relying so heavily on those movie theaters.
Okay, so less popcorn and comfy seats.
Yeah.
What else is there in the world of experiential real estate?
It's more about thinking outside the box, tapping into that desire for shared experiences, but in different ways. Like those immersive museums that are popping up everywhere.
Oh, yeah, those are cool.
Right. And what about escape rooms? Those are huge.
I've always wanted to try one of those.
You should.
Yeah.
Or even those high-end fitness studios. They're kind of experiential in a way. The point is, they're spreading their bets, not putting all their eggs in the movie theater basket anymore.
Diversification, right. So if one area takes a hit, it doesn't bring the whole house down. Makes sense. Did they make any other moves to stay afloat?
Oh, yeah. They got strategic. They sold off some of their theater holdings.
Cut their losses.
Yeah, but get this. They actually managed to sell 4 theaters for a $1.5 million gain.
Whoa! Is that even possible in this market?
Apparently. Talk about making the best of a bad situation.
What did they do with that money?
Well, they used it, along with some other savvy financial moves, to invest in some new acquisitions, some development projects, diversifying that portfolio we were just talking about.
It's like they reinvented themselves. So what's the verdict? Are they still paying a dividend?
Oh, yeah. They reinstated. It's almost 7% right now, and they've even started to increase it again. Slowly, but still.
Okay, so EPR's back in the game, at least for now. But let's be real. That's what we're here to figure out, right? Can these companies, WPC and EPR, really keep up these impressive yields for the next 10 years?
That's the million-dollar question. It's like trying to predict the weather 10 years out. You can look at the patterns, the history, make an educated guess.
But you never really know.
Exactly.
So, no crystal ball, but let's talk about those factors that could impact whether these REITs sink or swim, dividend-wise. What should our listeners be paying attention to?
Well, for starters, the real estate market is cyclical.
What does that mean exactly, for those of us who aren't real estate moguls?
Basically, what goes up must come down. It's a cycle. We've had a pretty good run with low interest rates for a while now.
And low interest rates are good for real estate because
it's cheaper to borrow money. People can afford to buy more houses, businesses can afford to expand, and REITs can afford to buy more properties. But if interest rates go up...
Uh-oh. I see where you're going with this.
Exactly. Higher interest rates mean higher borrowing costs for everybody, including REITs. A lot of these companies use debt to finance those big real estate purchases. So if their interest payments go up, it eats into their profits.
Less profit, less money for dividends.
Potentially. Yeah, that's one thing to watch. And then there's the overall economy, of course.
Right, because if the economy tanks...
People cut back on their spending, right? They're not going to the movies as much, not going on vacations. And that hurts those experiential properties EPR loves so much.
Oh, man, so true. I hadn't even thought of that. And even WPC, with all their warehouses and logistics centers, if we hit a recession, people might cut back on online shopping too, right?
Absolutely. Even the most future-proof industries can be affected when the economy takes a downturn. So it's not a guaranteed slam dunk either way. It's more about...
Risky risks and rewards.
Exactly. And that's where due diligence comes in.
Ooh, I love a good investigation. So how do our listeners... put on their detective hats and really dig into these companies?
Well, I'd say start with those debt levels. We talked about how higher interest rates could be a problem for REITs carrying a lot of debt.
So, they're basically over-leveraged.
Exactly. Too much debt makes them more vulnerable to those interest rate hikes. So listeners should be looking at things like debt ratios, trying to get a sense of how much debt these REITs are carrying and how risky that debt might be.
Got it. Debt check. What else?
Tenant diversification is huge. We talked about that with EPR and how they're branching out beyond just movie theaters.
Yeah, not putting all their eggs in one basket.
Right. But the same thing applies to WP Carey. Listeners should look at their tenant mix. Are they relying on a few big players, or do they have a nice spread of tenants across different industries?
Because if one of those big tenants goes under...
It could have a ripple effect, right? That's why diversification is key. spreads the risk around.
Okay, tenant diversification check. Anything else we need to be investigating?
One more thing, and this is a big one. Look at the management team.
The people actually running the show.
Yep. They're like the captains of the ship. You want to make sure they know what they're doing, especially if the waters start getting rough.
Right. Makes sense. So how do you evaluate a management team? What are we looking for here?
Experience, for one. Have they steered the company through tough times before? Have they been successful? You can find a lot of this information in their annual reports, company websites, that kind of thing.
Like doing a background check on the leadership.
Exactly. It's all about understanding who's at the helm.
Okay, so we've got debt levels, tenant mix, management team. What about the big question? Are these REITs, with their juicy yields, too good to be true?
It's a tough one, right? Because on the one hand, you've got these great yields.
Which we love.
Of course, who doesn't? But on the other hand, there's always that risk. And with REITs especially, it's not just about what's happening right now.
It's about what might happen down the road.
Exactly. We've talked about how WPC and EPR have adapted to the whole pandemic thing, the shift to e-commerce.
Which they've both done pretty well, it seems like.
Yeah, but what about the stuff we don't see coming? The curveballs.
No, I like where you're going with this. Give me an example. What kind of curveballs are we talking about?
Okay, so WPC is all in on industrial real estate, right? Warehouses, logistics centers.
Riding that e-commerce wave.
Exactly. But what if something comes along that disrupts e-commerce itself? Something nobody sees coming. Like, what if drone delivery really takes off?
Oh, interesting. Suddenly you don't need those big trucks on the road anymore.
Right. Or imagine if 3D printing gets so good, so cheap.
That manufacturing can become more localized. We wouldn't need to ship things across the country as much.
See, that's what I'm talking about. These are just hypotheticals.
Then it makes you think.
Exactly. You got to think long term.
Okay, that's WPC. What about EPR? Any curveballs lurking in the shadows for them?
Well, they're banking on this whole experiential thing, right?
Which is huge right now.
Yeah, people are craving those in-person experiences after being cooped up for so long.
Makes sense. Zoom fatigue is real.
Tell me about it. But here's the thing. What if the metaverse actually takes off?
Like, really takes off.
Yeah. People are spending more and more time in virtual worlds. What if that's how we're all socializing, going to concerts, even working in the future? Suddenly, those real-world experiences might not seem so appealing anymore.
Man, the future is wild.
Right. So my point is, you got to stay flexible.
Adaptable. Roll with the punches.
Exactly. And that's why, this whole deep dive, it's not just about these two specific REITs.
It's about the bigger picture.
Yeah. It's about giving people the tools to think critically about any investment, especially when those yields start looking really tempting.
Because high yields can be seductive.
No doubt. So if our listener is out there trying to make sense of all this, what would you say are the key takeaways here?
Well, first off, diversification is key.
Amen to that. Don't put all your eggs in one basket, no matter how much you love that basket.
Exactly. And the other thing is, remember, investing is a marathon, not a sprint.
So true. Those high yields are great, but sustainable growth, that takes time. It takes patience. And it takes a willingness to ride out the ups and downs of the market.
Because there will be ups and downs. Nobody gets a free pass.
Nope. No free lunches on Wall Street. But hey, that's part of the excitement, right?
For sure. So as we wrap up this deep dive, any final words of wisdom for our intrepid investor out there?
Just keep learning, keep asking questions, keep digging. The more you know, the better equipped you'll be to navigate the market and make those smart, informed investment decisions.
Couldn't have said it better myself. Thanks for taking this deep dive with us.